think DeFi is the hardest blow in the history of banks? Don't you think this war with TradFi is far from over? This is the best episode yet.
For over a century, Wall Street was it. The absolute gravitational center of global capital. You picture those glass towers, right? Rising over Manhattan. They weren't just buildings. They were monuments to concentrated finance.
Absolutely, symbols of power.
Totally. And every morning, that sound, the NYSE bell, it wasn't just starting the trading day. It felt like the sound of an empire kicking into gear.
A whole choreography.
Yeah, the whole financial world built on suits, marble, and, crucially, human promises. Okay, let's unpack this.
And that's the perfect setup, because it highlights the paradox we're really digging into today. That very system, the one that insisted centralization was essential, for stability and control.
Right, that was the justification.
And ended up becoming so top-heavy, so opaque, that it just systematically betrayed public trust. And not quietly either.
No, spectacularly.
Yeah.
2008 is burned into memory.
And then the shock of 2020. What we're seeing now, what the sources are showing, is this fundamental shift of power. It's moving away from those institutions, those physical cities, where it was all locked down.
Yeah, the old centers.
And it's moving to servers, to open source code. Power is becoming distributed. It's a really profound move from needing trust in people, often powerful, fallible people, to demanding verifiable trust only in math, immutable mathematics.
So our sources are telling us this isn't just like a tech upgrade. It's not just finance getting faster software.
No.
It's a radical reallocation of economic power. So our deep dive today, what we're focusing on is really analyzing that history, those core structural flaws in traditional centralized finance, then tracing the incredibly rapid and radical birth of this permissionless alternative decentralized finance, or DeFi.
Right.
And showing you, our listener, exactly how software, how code is now not just competing with, but actually surpassing the capability of concrete buildings and, corporate bureaucracy.
In the most critical areas, too.
Exactly. Credit, trading, derivatives, even passive yield. We're essentially looking at a structural war against the old Wall Street model. Okay, so let's step back. If you think about modern finance history, the 80s often feel like the absolute peak, right? The so-called golden age of Wall Street.
Oh, yeah, the movies, the culture.
Exactly. Finance wasn't just about money. It was fashion. It was excess, aggression. You imagine those trading pits before things got quiet.
The shouting.
The air probably smelled of adrenaline and, frankly, a kind of palpable arrogance.
Absolutely. Traders were almost mythical figures.
Yeah, these heroes in expensive suits, driving flashy cars. They were seen as the masters driving this relentless market expansion. The Dow tripled in, less than 10 years?
It looked untouchable from the outside, completely dominant.
But behind the scenes, that's where the paradox you mentioned comes in, right?
Precisely. It might have seemed dominant, but it was incredibly slow, heavy, and full of friction. That's the centralization paradox.
So beneath the glamour, it was this cumbersome machine.
Built on layers and layers of human intervention, regulatory hurdles. Think about just one trade.
Okay.
It goes through a broker, maybe multiple custodians, then clearinghouses to handle counterparty risk, auditors.
Right, checking everything.
And then finally, it settles. Days later, each step isn't free. It adds a cost, a fee.
And that fee is basically the price of needing human trust and oversight.
Exactly. And managing the risk that comes with manual processes and fallible people.
And that centralization, the thing they said provided stability, it only really worked by keeping people out, didn't it?
That's the key. It achieved stability by limiting accessibility. The market talked about free competition, but in practice, it was a rigid hierarchy.
So if you had a seat on the exchange or worked inside one of those big firms,
You had structural advantages. Our sources really emphasize this. The wealthy didn't just have more money, they had better information, faster information.
yeah, blinds.
Direct lines, faster phones back then, maybe even ways around certain regulations that a regular retail investor just couldn't access.
So it was capitalism, but kind of with an asterisk.
Yeah.
Capitalism with privileges.
Yeah, and the fiction, all those layers and costs, that was the moat. It protected the incumbents.
But that friction, that reliance on human trust, it was being quietly undermined by technology, wasn't it?
Quietly at first, then very, very quickly. This brings us to the silent rise of the machine.
Okay.
By the mid-90s, you start seeing it. That analog world, the human instinct, the shouting in the pits.
The visible chaos.
Yeah, it starts fading, replaced by the glow of computer screens. The actual infrastructure of the market was being rewritten, not by traders, but by software engineers optimizing how orders flowed.
And that process just accelerated, right? Leading to HFT.
High-frequency trading, yeah. Early 2000s, that's when the competition fundamentally shifted. It stopped being about who could think faster, who had the best intuition.
The gut feeling.
And became entirely about who could compute faster. It turned into this incredibly expensive race for nanoseconds.
Billions spent on infrastructure, right? Not people.
Exactly. Not on hiring brilliant traders, but on things like optimizing where data centers were located, laying specialized fiber optic cables in perfectly straight lines between exchanges.
Just to shave off microseconds.
The entire soul of how the market operated was being uploaded to silicon chips.
And the human traders.
Became obsolete really quickly. The data is stark. By 2012, something like 16,000 traders had vanished from the major exchange floors.
Wow.
The human drama was replaced by cold, hard logic gates. But this relentless drive for machine efficiency, it introduced a new problem.
Fragility.
Systemic fragility, yes. The system evolved so fast, became so complex that no single person could fully grasp it or control it anymore.
And that leads to things like the flash crash.
Exactly. 2010, the Dow drops 1,000 points in minutes. No clear human cause. The machines, they don't feel fear, but their speed and interconnectedness meant they could trigger these massive market-wide panic loops almost instantly.
So the system was faster, more efficient, but also brittle. And then came the real betrayal, you could say. The moment the myth of the fair market just died.
2008. For decades, people were told the system was robust, fair. But the near collapse of the entire global financial order showed the reality.
The moral hazard.
A huge moral hazard. Institutions like Lehman, AIG, the ones who caused the mess with reckless leverage,
They got bailed out.
instantly prioritized, rescued with trillions in taxpayer money. The message was crystal clear. The system protects itself. It protects the insiders before it protects you, the public.
That shattered trust. But then 2020 seemed to, I don't know, pulverize what was left.
I think that's fair. If 2008 cracked the foundation, the policy response in 2020 just demolished it for many people.
Because the world stopped. Economies froze overnight due to the pandemic.
Everything shut down.
But the markets, after a brief dip, just soared.
Right back up. And this time, the mechanism was so visible. Trillions in quantitative easing, stimulus checks. People were locked down at home watching this happen.
Wall Street booming while Main Street was sinking.
The disconnect was impossible to ignore. It felt like money wasn't being earned through productive activity anymore. It was just being manufactured by policy decisions made by a handful of people.
That financial betrayal right there on display.
I couldn't miss it. And that shock, that visual disparity, it became the ultimate catalyst.
For what? For seeking an alternative.
Exactly. It broke the psychological dependency on the old system for millions of people around the world. Stuck at home, seeing this, they started actively looking for something else.
A system with different rules?
A system where the rules were fixed, transparent, where money couldn't just be printed endlessly, where the game couldn't be paused or bailed out by insiders. That search for financial sovereignty, that's what ignited this revolution.
And the blueprint was already there, wasn't it? Almost poetically.
Waiting since 2009, yeah. Right after the 2008 crisis. Satoshi Nakamoto publishes that famous 9-page white paper.
Peer-to-peer electronic cash.
A declaration of financial independence, really. Offering trust without needing permission. Just cryptography, consensus, math.
Bitcoin was revolutionary, but maybe more like a digital vault, a store of value.
Primarily, yes. Hugely important, but limited in scope initially. The real game changer for finance, arguably, was Ethereum.
Why Ethereum?
Because Ethereum took the blockchain concept beyond just a ledger. It turned it into a programmable ecosystem, a world computer, essentially.
Allowing for smart contracts.
Exactly. These are just pieces of code, but they're self-executing, they're transparent for anyone to read, and crucially, they're immutable. Once deployed, that contract runs exactly as written.
Can't be bribed.
Cannot be bribed, cannot be persuaded, cannot be corrupted or shut down by a central authority. Finance finally had a language that could replace lawyers, escrow agents, settlement delays.
And that potential really exploded in 2020, didn't it? DeFi summer.
DeFi summer 2020, all that stimulus money flooding the system, a lot of it found its way into these new protocols. Suddenly, things like Avav for lending, Compound for borrowing, Uniswap for trading.
They weren't just experiments anymore.
No, they were handling serious volume. They proved, right there in plain sight, that global liquidity could move instantly, efficiently, without needing Wall Street middlemen, without needing anyone's permission. It was a functioning, parallel financial system built entirely on code, scaling incredibly fast.
Okay, so we've seen the problems, the flaws in the old centralized system, the erosion of trust. Now, let's shift gears. Let's look at the solutions being built.
Right, the engineering.
Here's where it gets really interesting. We're talking about the foundational protocols, what some call the triple crown of code, that started decentralizing the core functions: credit, trading, and derivatives.
Yeah, and this is finance being rebuilt from the ground up, using software instead of relying on institutional trust. The absolute core DNA in every case is the smart contract.
These self-executing contracts replacing the old legal frameworks, the human intermediaries.
Turning trust us into verify the code. It's non-negotiable trust and logic.
Let's start with credit. That's absolutely fundamental to any economy.
The lifeblood, yeah.
In traditional finance, getting credit is often a privilege, isn't it? It depends so much on subjective judgment.
Credit scores, applications, background checks. It's designed to exclude. Think about the unbanked or underbanked billions globally.
We're just locked out.
Completely. MakerDAO directly challenged that structure. It created what you could argue is the first truly decentralized financial institution built entirely in code.
And they created DAI.
DAI, yeah. A synthetic digital dollar designed to stay stable around $1. But it's not backed by cash in a vault or government promises.
It's backed by crypto collateral locked in a smart contract.
Exactly. Over-collateralized crypto assets like Ether, wrapped Bitcoin, locked securely in a smart contract called a vault.
Okay, so how does that actually work, the mechanics?
It's actually quite elegant and disruptive. A user deposits volatile collateral, say $150 worth of ETH, into their vault. Then they can automatically mint or borrow up to maybe $100 worth of DAI against that collateral. It's an over-collateralized loan, typically needs 150%, sometimes more collateral for every 100% borrowed.
And the loan is instant.
Instantaneous, settled right there on the blockchain. But the really crucial part is the safety mechanism, automated liquidation.
Right. What happens if the ETH price crashes?
If the value of your collateral drops, maybe due to market volatility, and it gets close to that minimum required ratio.
The 150% mark, for example.
Right. The system doesn't wait. It automatically sells off enough of your collateral on the open market to repay the DAI debt plus a penalty.
Automatically. No human involved.
Zero human intervention. It's executed by the code itself. No reminder emails, no phone calls from a collections agent, no negotiation possible. Just math, enforced by the blockchain.
That's very different.
It's fundamentally different. And by achieving this, MakerDAO attacked Wall Street's most guarded fortress, the monopoly over creating money and issuing credit.
Because traditionally, only licensed banks could do that.
Only banks. MakerDAO essentially democratized money generation. It turned borrowing from a privilege you had to apply for into an accessible, permissionless right for anyone with internet and the required collateral.
Okay, so that's credit decentralized. What about spot trading? Buying and selling assets right now.
If MakerDAO cracked credit, Uniswap just shattered the traditional spot trading model, completely reimagined it.
How so? Traditionally, it's all about order books, right? Matching buyers and sellers.
Exactly. And order books require professional market makers, huge institutions like Citadel or Jane Street with deep pockets. They provide the liquidity, stand ready to buy or sell, and make money on the spread, the tiny difference between buy and sell prices.
But that concentration of capital means smaller assets, niche tokens. They often have no liquidity.
Right. It creates this cycle of exclusion. If there's no liquidity, it's hard to trade, so no one wants it, so there's no liquidity. Uniswap just blew that up with the automated market maker, the AMM.
Okay, AMM. How does that work without an order book?
Instead of matching specific buy and sell orders, it uses these things called liquidity pools. Imagine a pool with two assets, say ETH and a stablecoin like USDC. The price is determined automatically by a simple mathematical formula, often X times Y equals K, where X and Y are the amounts of the two tokens in the pool and K is a constant.
So when someone trades...
When someone wants to buy ETH from the pool, they add USDC. This changes the ratio of ETH to USDC in the pool, and the formula automatically adjusts the price along a curve. It's price discovery via algorithm, not matching orders.
Okay, but where does the liquidity come from? Who puts the ETH and USDC in the pool?
And this is the revolutionary part. Anyone. You, me, anyone, anywhere in the world. This is people-powered liquidity.
So regular users provide the assets.
Yes. You deposit a pair of tokens, say ETH and USDC, into the pool. You become a liquidity provider, an LP. In return, you get LP tokens representing your share of that pool.
And why would I do that?
Because every time someone trades using that pool, they pay a small fee, typically around 0.3%. And that fee, it's automatically distributed proportionally to all the LPs in that pool.
So the users earn the trading fees.
Exactly. It's a total inversion of the old model. Instead of giant market-making firms capturing the profits from spreads, the users who provide the liquidity earn those profits. You don't need millions in capital or a special license. You become the infrastructure.
That's a powerful shift. But Uniswap didn't stop there, right? They evolved the AMM model.
It kept innovating. They realized the basic V2 formula, that psi k, was actually quite capital inefficient.
How so?
Because it spread the liquidity evenly across all possible prices, from 0 to infinity. But most trading happens in a much tighter range, right?
Yeah, ETH isn't going to trade at $1 or $1 million tomorrow, probably.
Exactly. So most of the capital LPs deposited was just sitting there, dormant, unused, far away from the current price. That led to Uniswap v3 and this concept of concentrated liquidity.
Concentrated liquidity, what's that?
It lets LPs choose specific price ranges where they want their capital to be active. So instead of providing liquidity from 0 to infinity, you might say, I only want my ETH's liquidity to be used if ETH is trading between $3,000 and $4,000.
So you focus your capital where the action is.
Precisely. This makes the capital vastly more efficient. In stable pools like USDCDAI, V3 can achieve up to 4,000 times the capital efficiency of V2.
4,000 times.
That's the claim. It means decentralized infrastructure can provide incredibly deep, efficient liquidity, the kind previously only possible on massive centralized exchanges, but with far less total capital locked up. It's a structural leap.
Okay, so we've got decentralized credit with Maker, decentralized spot trading with Uniswap. What about the really complex stuff? Derivatives.
Derivatives. Futures, options, swaps. The most lucrative and arguably the most intentionally walled-off garden in all of finance.
Yeah, traditionally locked away from retail investors.
Totally. Behind layers of accredited investor rules, high capital minimums, retail was explicitly told, this is too complex, too risky for you.
Which just created this huge pent-up demand, didn't it?
Massive suppressed demand. And that vacuum was first really exposed, not by DeFi initially, but by a centralized exchange that was nonetheless radical. BitMEX back in 2014.
BitMEX. Controversial but influential.
Hugely influential, led by Arthur Hayes. They did two key things. First, they gave ordinary people access to crazy leverage, sometimes up to 100x.
Which regulators obviously loved.
Not exactly. But second, and more structurally important, they popularized the perpetual contract, or perp.
The perp. It's not a traditional future, right? No expiration date.
Exactly. Traditional futures expire, which creates hassle and overhead you have to roll your position. Perps don't expire. They stay pegged to the underlying spot price using a clever mechanism called the funding rate.
How does that work?
If the perp price drifts too far above the spot price, traders who are long the perp periodically pay a small fee to traders who are short. If it drifts below, shorts pay longs.
So it creates an incentive to push the price back towards the real spot price.
Precisely. It's this simple, automated mechanism that manages the basis risk and keeps the perp anchored without needing expirations or manual intervention. Genius, really.
And BitMEX proved people wanted this.
They proved there was colossal global demand for these sophisticated tools among retail traders, from students in dorm rooms to savvy operators everywhere. Wall Street, obsessed with control and high fees for institutions, had completely ignored this market.
They created a regulatory blind spot.
A huge one. Now, BitMEX itself was centralized and eventually ran into major regulatory trouble, but it provided the undeniable proof of concept. It laid out the architectural blueprint.
The blueprint for decentralized derivatives.
Exactly. It showed that these complex products could be managed algorithmically. The next generation, the truly decentralized protocols like DYDX and GMX, they took that perpetual contract model and just removed the final point of failure, the central exchange operator. They put it all on chain.
All right, so we've seen the building blocks. Maker, Uniswap, the perp concept pioneered by BitMEX, and then decentralized. Now let's pivot to the core argument. The actual structural supremacy of this code-based finance over the old concrete and SUS model.
This is where the rubber meets the road. It's about the tipping point, when the technology didn't just offer an alternative, but became demonstrably superior.
Is there a moment, a data point that really shows this?
I think there is. Look at late 2024, early 2025. Hyperliquid, a decentralized perpetuals exchange running on its own chain, started posting daily trading volumes.
Okay.
That on certain peak days didn't just rival, but actually exceeded the volume being processed by NASDAQ's own crypto derivatives market.
Wait, hang on. NASDAQ,
The
not
NASDAQ.
NASDAQ. Let that sink in.
Yeah.
You've got NASDAQ, founded 1971, billions sunk into physical infrastructure, massive regulatory apparatus, thousands of employees.
Decades of history, brand recognition.
Right. Being matched or beaten in daily volume by a software protocol, Hyperliquid, founded in just 2023, run entirely by code, secured by a decentralized network, zero traditional buildings or bureaucracy.
It's a declaration. The future of global derivatives isn't being built in New York skyscrapers or Chicago trading pits anymore. It's being written in code languages like Solidity, Rust on global blockchains that no single entity can just switch off.
So why? What gives DeFi this structural advantage? What makes the code beat the concrete?
It boils down to inherent advantages that traditional finance or TradFi simply cannot replicate without completely gutting its existing model. First off, speed without friction.
Okay, true.
TradFi runs on T+2 settlement. You make a trade, the actual money and assets don't change hands for 2 business days.
Because of all the intermediaries, brokers, custodians, clearinghouses.
Exactly. They need time to manage counterparty risk. On-chain derivatives, they settle instantly. The moment the trade executes on the blockchain, it's final.
So TradFi speed is bottlenecked, expensive DeFi speed is just built in.
It's the default feature of the tech. Second big advantage, 247 global access.
Right, if the markets never sleep.
Literally never close. No weekends off, no holidays, no 4 p.m. closing bell. And the access is truly radically flat.
What do you mean by flat?
I mean, a 19-year-old developer sitting in Lagos with a basic internet connection and some collateral in a crypto wallet
Okay.
has the exact same access to deep liquidity, the exact same sophisticated trading tools as a multi-billion-dollar hedge fund manager in a Manhattan tent house.
It's just need a wallet and collateral.
That's it. That level playing field has never existed before in the history of finance. It's revolutionary.
Okay, speed, access, what's the third leg?
Transparency and resilience. In TradFi, trust is fundamentally opaque. It's a chain of human promises backed by complex regulations you hope are being enforced.
And we saw how that trust can break down. 2008, 2020.
Precisely. In DeFi, the rules of the game are open source code. Every single transaction, every liquidation, every fee paid, it's all recorded permanently on a public blockchain. Anyone can audit it.
So no backroom deals.
No emergency meetings where powerful executives decide to temporarily pause withdrawals or change the rules because they're losing. The code runs exactly as written, transparently, without fear or favor.
Let's dive into the architecture a bit. How do different protocols achieve this? You mentioned GMX earlier. They took a different path than, say, an order book model.
Right. GMX pioneered a really radical approach, especially in their V1 and V2 iterations. They basically threw out the order book entirely.
No matching buyers and sellers.
No. Instead, they used a single unified liquidity pool called the GLP pool. Think of it as a big basket of assets, some BTC, ETH, stablecoins, etc.
Okay, a basket.
And this GLP pool acts as the sole counterparty to every single trade on the platform.
So if I want to go long ETH, I'm trading directly against the pool.
Exactly. You're betting against the pool. If you make a winning trade, the profit comes out of the pool. If you lose money on the trade,
The pool keeps it.
your loss flows directly into the pool, increasing the value for everyone who provided liquidity to that pool. The LPs essentially are the house.
And this is where the yield comes from for the LPs.
A big part of it, yeah. GMX LPs earn real yield, meaning yield derived from actual economic activity on the platform, not just inflationary token rewards. They get a share of trading fees, fees from borrowers leveraging assets, and, yes, the net losses from traders who bet against the pool and lose.
And the reported yields are pretty high.
Sources show LPs in these pools were seeing sustainable APYs, annual percentage yields ranging from 15% up to sometimes over 40%. In the traditional world, getting that kind of return on passive, liquid assets is basically unheard of. It shows how much value is usually extracted by middlemen.
But hold on, isn't that incredibly risky for the LPs? If a bunch of really smart traders consistently win against the pool,
Then the LPs lose money? Absolutely.
the house could go broke, essentially.
That's the fundamental counterparty risk the LPs take on. The high yield is compensation for that risk. If traders collectively extract more value than the fees and losing trades generate, the GLP value goes down.
So Wall Street firms manage that risk internally. Here, the risk is distributed to the liquidity providers.
Exactly. It's a different model of risk management. GMX tries to balance it with fee structures, careful asset weighting in the pool, and relying, frankly, on the statistical likelihood that most retail traders lose money over time. But the core idea stands. The decentralized collective owns the risk and captures the revenue.
Okay, so that's the GMX model. Unified pool, LPs are the house. What about DYDX? They went a different way, right? Kept the order book.
Totally different philosophy. DYDX aimed for institutional-grade performance, the speed and feel of a traditional exchange order book, but built on decentralized rails.
How did they manage that? Order books are notoriously hard to run efficiently on slower blockchains.
They realized that early on. Running a high-throughput order book directly on a congested chain like Ethereum just wasn't going to cut it for professional traders who need near-instant execution.
Latency kills them.
Kills them.
Yeah.
So for their big V4 upgrade, DYDX made a really bold move. They launched their very own application-specific blockchain using the Cosmos SDK.
Their own chain, just for their exchange.
Just for the DYDX exchange. This gave them complete control over the block production, validation, and optimization. It allowed them to achieve sub-1 second transaction finality and offer completely gas-free trading for the user.
Gas-free, that's huge in crypto.
Massive user experience improvement. So DYDX proved you don't have to sacrifice the familiar order book experience or top-tier performance to get decentralization and non-custodial security.
So they built their own custom infrastructure to solve the speed problem while keeping user funds secure.
Exactly. It showed that decentralized systems could be engineered to be faster, cheaper, and arguably more resilient than even institutional centralized platforms.
Okay, so two different successful architectures, GMX pool, DYDX order book on its own chain. But you mentioned they share a secret weapon.
They do, something Wall Street is structurally, fundamentally incapable of replicating the ownership advantage. This comes from tokenomics, specifically things like airdrops and points systems.
Airdrops. This is DeFi's cultural phenomenon, isn't it? Giving away tokens.
It's a masterstroke. An airdrop is when a protocol distributes its native token, which might grant governance rights, a share of future revenue, or just speculative value directly to its early users and contributors. Usually for free or based on past usage. It instantly turns a simple user or customer into an owner, a stakeholder. It creates incredible viral growth and fierce community loyalty.
And some of these airdrops have been worth serious money.
The anecdotes are legendary. They define this potential for generational wealth transfer. The original Uniswap airdrop back in 2020 gave 400 UNI tokens to every wallet that had ever interacted with the protocol.
400 UNI.
At its peak price, that airdrop was worth something like $17,000 for just making one trade. More recently, there are reports estimating the total value of Hyperliquid's HYPE token airdrop, distributed to users based on trading activity, exceeded $10 billion on paper at launch.
$10 billion given away.
Given away to incentivize usage and build a community of owners. When you're a stakeholder like that, you're motivated. You promote the protocol, you provide feedback, you defend it online.
It creates this powerful, virtuous cycle. Liquidity attracts users. Users get ownership. Owners bring more liquidity.
And an unbeatable growth loop. But let me push back on that slightly. Isn't this ownership model under attack? Regulators like the SEC keep saying these governance tokens are unregistered securities.
That's the $1 million or maybe $1 billion question right now.
Right. Doesn't that threaten the whole airdrop advantage?
It absolutely does. The regulatory assault is clearly targeting this shared ownership model. It's the main point of friction. However, DeFi's design gives it resilience.
How so?
These protocols are global by default. Even if one country, like the US, cracks down on classifying or distributing these tokens,
the protocol still runs everywhere else.
Exactly. And the code is often open source. The pressure often just forces protocols to become even more decentralized, maybe moving governance off-chain or using structures that are harder to pin down legally. It's an evolutionary pressure.
So regulation becomes a driver for more decentralization.
In many ways, yes. Compare that to Wall Street. They are fundamentally blocked by existing securities laws and their own internal structures from just giving away billions of dollars worth of equity or future revenue streams to retail customers.
They can't just airdrop BlackRock shares to everyone who uses their app.
Exactly. It's impossible under the current framework. Wall Street is built to extract value from users. DeFi fundamentally is architected to share value with its users and builders. That difference is profound and very hard to regulate away completely. Okay, so DeFi is winning on structure, speed, access, ownership. Wall Street must have noticed this by, say, 2023. They weren't just going to sit back.
No, they finally started to wake up to the existential threat. Their first major defensive move was pretty predictable, actually.
Cool, was it?
Co-option. Trying to adopt the language and some of the tech, but keep control. We saw this with tokenization.
Tokenization, putting real-world assets on a blockchain.
Exactly. Big players, even BlackRock, launched tokenized funds, like their BUIDL fund, which represents shares in a money market fund, but on the Ethereum blockchain.
Sounds innovative. Using the tech.
On the surface. But it was fundamentally what some call innovation theater. They tokenized the asset, yes, the digital representation of the fund share, but they absolutely did not tokenize the access. These products are still heavily gated.
How so?
Strict know your customer, KYC requirements, massive minimum investments. The BUIDL fund reportedly requires $5 million minimum.
$5 million, so not for retail.
Definitely not. Plus, they're custodial, meaning you don't truly hold the asset yourself, and they often run on private permission blockchains that aren't composable with the wider DeFi ecosystem.
So it's fragmentation, not integration.
It's replicating the old walled garden system, just using blockchain buzzwords. They use the tech to make their own internal operations slightly more efficient, maybe lower some costs for themselves.
But didn't pass those benefits or the access on to the average user.
Not really. It maintained the existing power structure, the existing walls of exclusion, an efficiency upgrade for them, not a power shift for you.
Okay, so tokenization was more defense than offense. Where's the real structural conflict happening now?
I'd argue it's in the battle for yield. This cuts right to the core of banking and the broken promise of traditional savings.
Broken promise.
Think about it. By 2020, what was a typical savings account paying? 0.1%, maybe 0.05% APY if you were lucky.
Basically nothing. You were losing money to inflation.
Exactly. You were being punished for saving cash. Meanwhile, what are the banks doing with your money?
Lending it out. Mortgages, credit cards.
Lending it out at much higher rates, 8%, 12%, sometimes more. They take your capital, pay you practically zero, lend it high, and pocket the huge difference.
That's the middleman tax.
That's the core profit engine of commercial banking. It relies on paying depositors as little as possible.
How does DeFi counter that? Staking.
Staking is the first revolution here. Proof-of-stake blockchains need validators to secure the network, process transactions. Instead of miners burning electricity, validators lock up capital, they stake the network's native token.
And they get paid for that.
Yes. They earn rewards, often directly from the network's inflation schedule and a share of transaction fees. These yields can be substantial, ranging from maybe 3% to over 20% AQY, depending on the network and conditions.
And there's no bank in the middle taking a cut.
No middleman. The yield is generated by the protocol's economics and distributed automatically by code directly to those securing the network. It's inherently more efficient.
Okay, but staking usually means locking up your crypto, right? You can't use it for anything else.
That was the limitation, the opportunity cost, which led to the next big innovation: liquid staking derivatives, or LSDs.
LSDs, like Lido Steth.
Lido and Stith are the prime example. They solved the lockup problem. You stake your ETH through Lido, you start earning the staking yield.
But you also get back.
You get back a liquid token, Stith, which represents your staked ETH, plus the accumulating rewards. It's a derivative that stays liquid.
And I can use that Steth.
That's the magic. You can use Stith just like regular ETH across the DeFi ecosystem. Use it as collateral to borrow stablecoins on Aave, provide liquidity on Curve or Uniswap, trade it.
So you're earning the base staking yield plus potentially earning more yield from using the liquid token elsewhere.
Exactly. It's financial alchemy, combining yield generation with liquidity and utility. It turns a previously idle, locked asset into a productive, multi-purpose capital instrument.
Wall Street just doesn't have anything like that, do they?
Nothing even close in terms of capital efficiency and composability for retail users.
And now there's another layer: restaking.
Restaking is the bleeding edge, pioneered primarily by Eigenlayer. It takes the LSD concept even further.
How does restaking work?
The core idea is that the security provided by staked ETH is incredibly valuable. EigenLayer allows users to take their staked ETH, either directly staked or via an LSD like Steph, and reuse that same staked capital to provide security for multiple other protocols and services simultaneously.
So the same collateral secures the main Ethereum network and other applications.
Yes, things like bridges, data availability layers, Oracle networks, what EigenLayer calls actively validated services, or AVSs. These services need economic security, and restakers provide it using their existing staked ETH.
And they get paid for providing this additional security.
They earn additional rewards from each AVS they help secure, on top of their base ETH staking yield. So you're stacking yields.
Multiple income streams from the same initial capital.
Exactly. When you factor in the base ETH yield, plus the rewards from multiple AVSs, plus potential airdrops from new protocols launching on EigenLayer that want to attract restakers,
The potential effective APY could be really high.
some analyses suggest potential effective APYs, once the ecosystem matures, could range from 30%, maybe even up to 50% or more, depending on the risks taken and the rewards offered.
Okay, the obvious question then, why can't my bank offer me 30% yield? They manage huge pools of capital.
They are structurally, fundamentally incapable of doing it, for several reasons.
Like what?
First, regulation. Banks operate under strict rules like capital reserve requirements. They have to hold a significant chunk of capital aside, doing nothing, just as a buffer. That drags down overall returns.
Okay. Regulatory burden?
Second, and more importantly, their entire business model relies on incentive misalignment. They make money by paying you, the depositor, as little as possible, maximizing their net interest margin.
If they paid 30%.
Their whole lending business collapses overnight. They have no incentive to pass yield through. DeFi protocols, on the other hand, are often incentivized to pay high yields to attract staked capital, because that capital directly increases the security, utility, and ultimately the value of their network.
The incentives are aligned with the user providing capital.
Exactly. It's a completely different economic model.
All right, so DeFi is outcompeting on yield structure. That leaves us to the final battleground, doesn't it? Regulation versus resilience.
The inevitable conflict. As DeFi started clearly winning on technical and economic grounds, Wall Street and the traditional system did the only thing they could do effectively.
Call in the government.
Precisely. Unleash the regulators. We've seen a coordinated effort from the SEC, the CFTC, the Treasury, various global bodies,
Trying to apply old rules to this new system.
attempting to regulate DeFi protocols, often trying to fit them into existing frameworks, claiming tokens are unregistered securities, demanding KYC on decentralized stablecoins, targeting developers.
It feels like a fight for control.
It absolutely is. It's a fundamental fight over who controls money, who controls access to financial services. DeFi inherently challenges the centuries-old government and banking monopoly on finance.
But you mentioned resilience. How does DeFi fight back against state-level pressure?
It was built, often intentionally, to be structurally difficult to stop. That's the core tension.
How so? No single point of failure.
Exactly. There's usually no CEO to arrest, no corporate headquarters building to raid or shut down, no central server bank you can unplug.
The code runs everywhere.
On potentially thousands of computers, nodes distributed globally, how do you issue a subpoena to a piece of code running autonomously on a decentralized network? You can't just switch it off. Uniswap keeps routing trades, even if the company that initially developed it disappears.
And what if they do manage to target the initial developers or the main website?
That's where forkability comes in. The vast majority of DeFi code is open source. Anyone can view it, copy it.
So if one version gets shut down,
The community can instantly take the entire code base, maybe make a few tweaks and redeploy it. Launch a new, functionally identical version, maybe hosted in a different jurisdiction or run by an anonymous collective. It can reappear overnight.
it's like whack-a-mole for regulators.
It moves at the speed of the internet. Regulation moves at the speed of government bureaucracy. Every regulatory action, every attempt to shut something down, often just acts as an evolutionary forcing function.
Making the next version stronger, more decentralized.
More resilient, more legally ambiguous, better designed to resist censorship or control. The pressure breeds adaptation. Hashtag outro.
Okay, we've covered a lot of ground, from the gilded cages of 80s Wall Street to the open source protocols of today. So what does this all mean? What's the takeaway for the future of finance and, for you listening?
I think the core takeaway is that power is fundamentally shifting. Irrevocably, it's moving away from CEOs and boardrooms you have to trust,
To code you can verify.
to code you can verify. away from trust in fallible human promises towards verifiable trust in mathematics and cryptography. The sources we've looked at, the data, it clearly shows the structural benefits emerging.
Right, the 247 global access.
Drastically lower fees because you remove the layers of middlemen.
Radical transparency, everything on chain.
And maybe most importantly, that shared ownership.
Yeah.
The token economics, the airdrops, turning users into stakeholders.
And this isn't just about technology, is it? You mentioned a generational aspect.
I think that's crucial. You have millennials, Gen Z generations who grew up seeing the 2008 bailouts, witnessing the 2020 interventions firsthand.
They don't have the same innate trust in the old institutions.
They have near zero intrinsic trust in that centralized system. And once someone experiences genuine financial sovereignty, the feeling of moving significant value across borders in minutes without asking permission, or earning 20% yield on their savings directly from a protocol, not a bank.
It's hard to go back to the old way.
It's very hard to go back. Why would you accept the high fees, the delays, the opaque rules, the gatekeeping of the traditional system once you've tasted that freedom and efficiency? They simply won't accept those constraints again.
So we've established DeFi is essentially rebuilt core financial functions. Credit via MakerDAO, spot trading with Uniswap, high-performance derivatives like DYDX and Hyperliquid, savings and yield through staking, liquid staking, restaking.
All operating globally, 247, largely without traditional banks, brokers, or clearinghouses.
Which brings us to that final, maybe uncomfortable, provocative thought for you, the listener. The question that really defines the next era of finance.
If we can now demonstrably rebuild the entire global financial system, credit, trading, derivatives, yield using nothing but transparent, open source code running on decentralized networks.
Then why do we still need Wall Street?
Exactly. What is its fundamental purpose anymore? The data, the structural advantages we've unpacked, they suggest a really unsettling answer for the incumbents. We don't necessarily need them for basic access anymore. We don't need them for liquidity provision in the same way. We certainly don't need them for permission or innovation.
The center is dispersing.
The center is becoming everywhere, distributed, enforced by math and code. The age of permissionless finance hasn't just started. Based on the sources, it's already well underway and accelerating.